In the short term, the market is a voting machine. In the long term, it is a weighing machine. Warren Buffett. This powerful quote from Buffett encapsulates one of the greatest lessons about how the financial market works. Many beginner investors, and even some experienced ones, fall into the trap of seeing the stock market as a giant casino where gains and losses are merely the result of luck. But does the market really work that way? Over decades, Buffett built his fortune and reputation not by gambling on luck, but by understanding the essence of businesses and the market. The difference between speculation and investment lies precisely in this understanding. While the casino depends on chance, the financial market rewards those with patience, knowledge, and strategy. In the long run, well-managed companies with solid fundamentals tend to reflect their true value, regardless of daily fluctuations. So why do so many people still see the market as a game of chance? The answer may lie in the ease of access to investment platforms, the influence of social media, and the pursuit of quick gains. The market's volatility, with its daily ups and downs, can mislead unprepared investors into believing it's all a matter of luck, and that's exactly what we're going to talk about today. I'll show you why the stock market is not a casino and how Buffett's investment philosophy can help you build wealth consistently. We'll explore the differences between speculation and investment, understand the importance of knowing a company's real value, and see how patience can be your greatest ally in the world of investing. If you're curious to discover how to transform your perspective on the financial market and learn to invest like the greats, stick with me until the end. You'll realize that the real game isn't about luck, but about strategy, discipline, and knowledge. To understand why the market is not a casino, we must first grasp the fundamental difference between speculation and investment. Buffett has always emphasized that investing means buying a real part of a business, while speculation is betting on price movements without considering the intrinsic value of the asset. This distinction is crucial to avoiding financial traps. In a casino, the odds are always stacked in favor of the house. No matter how often someone may win occasionally, the system is designed to ensure that in the long run, the casino comes out ahead. In the financial market, however, informed investors can consistently achieve positive returns because they are buying productive assets, companies that generate profits, grow, and create value over time. Buffett exemplifies this with his investment in Coca-Cola. He didn't buy shares of the company expecting a quick surge. On the contrary, he studied the business model, analyzed its consistent profits, and recognized that Coca-Cola had a globally recognized brand and a durable competitive advantage. He invested with the next decades in mind, not the next months. This is true investing, betting on the sustainable growth of solid businesses. Speculators, on the other hand, are more concerned with what the market will do tomorrow. They rely on rumors, trends, and quick moves, often ignoring the company's fundamentals. This short-term mindset can be dangerous and frequently leads to significant losses. Buffett warns about this, saying, "Risk comes from not knowing what you're doing." Another clear example of Buffett's philosophy is his approach during market crises. In moments of widespread panic, when many sell their shares out of fear, Buffett sees opportunities. He believes that the market sometimes underestimates or overestimates companies in the short term, creating price distortions. In these situations, he follows his famous advice: be fearful when others are greedy, and greedy when others are fearful. Imagine an investor who sees the market declining and decides to sell all their shares, fearing greater losses. This behavior is typical of someone who views the market as a casino. They act emotionally, without assessing whether the companies they own still have strong fundamentals. The disciplined investor, inspired by Buffett, uses this moment to buy shares of solid companies at a discount, taking advantage of widespread fear. Furthermore, Buffett avoids trends and businesses he doesn't fully understand. This leads us to another essential lesson. Invest only in what you know. Many investors get carried away by trendy sectors, as happened with tech companies during the dot-com bubble, or more recently, with cryptocurrencies. Buffett, on the other hand, has always preferred predictable businesses with clear revenue generation models. He says, "Never invest in a business you can't understand." This philosophy protects investors from making mistakes driven by greed or lack of understanding. While speculators bet on volatile trends, Buffett invests in companies with a history of consistent profits, good management, and essential products or services. Finally, a long-term mindset is what differentiates the investor from the gambler. Buffett often says he prefers to hold a stock forever if the business remains healthy. This thinking contrasts completely with the pursuit of quick profits. In the market, true gains come over time through the growth of companies and the appreciation of their profits. Therefore, understanding that investing means becoming a partner in a business rather than betting on price movements is essential to building sustainable wealth. The financial market rewards knowledge, patience, and discipline. It is not a casino, and those who treat it as such will rarely achieve long-term success. To further explore the idea that the market is not a casino, we need to delve into other fundamental pillars of Buffett's philosophy: patience, evaluating undervalued stocks, and the ability to capitalize on market crises. A crucial principle of Buffett's philosophy is analyzing a company's intrinsic value. Buffett doesn't concern himself with short-term market prices. He focuses on understanding the true value of the business. This process involves studying the company's financial health, cash flow generation capacity, management quality, and growth prospects. Buffett uses a simple analogy to explain this. Imagine you're buying a farm. You don't evaluate it based on the prices neighbors paid or on someone else's opinion of its worth. You look at the farm's productivity, soil quality, crops, and profitability over the years. The same principle applies to the stock market. Buffett seeks undervalued stocks, meaning companies being traded at prices below their actual worth. This buying for less than it's worth strategy creates a margin of safety, protecting the investor from losses and maximizing potential gains. This concept was inherited from his mentor, Benjamin Graham, author of the classic The Intelligent Investor. An example of this was Buffett's acquisition of American Express in the 1960s. The company faced a reputational crisis due to a financial scandal. The market overreacted, driving the stock price down. Buffett realized the issue was temporary and that American Express's business model remained strong. He purchased a large number of shares at low prices, and as the company recovered, it generated extraordinary returns. Buffett has always viewed crises as moments of opportunity. Instead of panicking, he follows his own rule: buy at the sound of cannons, sell at the sound of violins. This teaching reinforces that times of uncertainty are ideal for purchasing shares of solid companies that are temporarily undervalued. During the 2020 crisis caused by the pandemic, the global market collapsed. Many investors sold their shares in desperation, but Buffett remained calm. Although he sold some holdings in airlines, he also strengthened positions in resilient companies and focused on maintaining liquidity to capitalize on future opportunities. This approach shows that Buffett does not react impulsively to market downturns. He understands that the market is volatile in the short term, but trusts in the long-term recovery of solid businesses. Buffett also emphasizes the importance of discipline. In a market where everyone is chasing the next million-dollar investment, staying true to basic principles can be challenging. Yet it is precisely this consistency that separates successful investors from speculators. One example of this is Buffett's decision to avoid technology companies for much of his career. He admitted that he didn't fully understand the sector and therefore preferred to invest in predictable businesses with clear revenue models. It was only when he understood Apple's business model that he decided to invest, making it one of the most profitable holdings of his career. Another key point is the concept of compound interest. Buffett understands that letting investments grow over time without interruptions amplifies returns. It's like planting a tree. It doesn't bear fruit immediately, but with care and time, it grows and produces abundantly. Buffett advises investors not to be swayed by headlines or market noise. He says, "What matters is not what the market is doing, but the performance of the businesses you invest in." In other words, it doesn't matter whether the market is up or down, as long as the companies you invest in continue generating profits and growing. Many investors make decisions based on alarming news or short-term forecasts, but Buffett teaches that the focus should always be on long-term value. Throughout this video, it has become clear that the financial market is not a casino, but an environment that rewards patience, knowledge, and discipline. Buffett teaches us that investing is not a game of chance, but a strategic process requiring deep analysis, a long-term mindset, and the courage to act when everyone else is afraid. Remember that investing means becoming a partner in great businesses. The market rewards those who think about the future and have the courage to act when few others do. If you enjoyed these lessons and want to learn more about achieving financial success inspired by great investors, don't forget to like this video and subscribe to the channel. This way, you won't miss any content that can transform your perspective on finances and investments. See you in the next video.